What's going on, you guys? And thank you so much for tuning in for an episode of The Mortgage Mindset. Hey, real quick, I just want to remind you that we do not run any advertising on this show, and we are looking to grow it organically. So we cannot do that without your support. So if you find value in the show, if you got some information that you found really useful, please share the show, send it to somebody that you think might find some value in it as well. So without further ado, let's get to it. What's going on, everybody, and welcome to the show. I'm Trevor Otsuka, your host for The Mortgage Mindset, and we are going to be switching up the show a little bit. We are going to be launching this podcast series. What you can expect when you tune in is going to be the following. So we're going to start with a really brief market update. I'm going to tell you what's happening with rates. I'm also going to tell you a little bit about things that are coming down the pipe that could possibly impact our industry as far as real estate goes, as far as mortgages go. Definitely going to keep you updated on those things. Then, whenever I'm not doing a solo show, whenever I have a guest, I will be doing an interview segment for that guest, and that guest could be in the real estate industry. They might be an entrepreneur that owns their own business and they work in an entirely different field. Then after the interview segment, we're going to roll into a national news article headline that is specifically pertaining to real estate. And I'm gonna read the article itself, just kind of highlight some key points, and then the actual headline for the article. And then I'm gonna ask the guest to extrapolate what they think it is going to do for impacting the housing market, impacting real estate, both the short and the long term. So first, allow me to take a moment and just express my gratitude to you for tuning in and listening in on the podcast, on the show. I cannot express to you enough how grateful I am for giving me your time, your most valuable asset. So I really appreciate that. You can tune in on this. I do want to tell you as well, just a disclaimer, I am not a financial advisor. I am just relaying to you really the market data that I have available to me through the various resources that are available online. I'll definitely include the links for you on this as well, should you reach out and you want them. So let's jump right into the market update. So today is actually Monday, the 16th of October at the time of filming this. And for national rates, this is going to be pulled from Mortgage News Daily. So the website for this is mortgagenewsdaily.com/mortgage-rates. So you can go there every day. You can take a look and see what the national average is for the various loan programs. For conventional 30-year fixed, we're sitting at 7.8%. For 15 years, 7.1. And then for a 30-year jumbo, national average is 7.9. For FHA, we're sitting about 7.25, so 7.22. And then 30-year VA is pretty much the exact same as FHA. So last week, we had the CPI report that came out. So we took a little hit when that market data came a little hot. As far as what's happening in the market that could impact really housing altogether, FannieMae made an announcement that they are going to be updating their minimum down payment requirements for multi-unit purchases for primary residence. So what does that mean? Let's say that you were going to buy a 2-unit duplex and you wanted to live in the vacant unit. Well, previously, you had to bring in a pretty damn good amount of money. It was going to be 15% was your minimum down payment. Then if you ventured into a triplex or a 4-unit, that jumped up significantly. Your minimum down payment was going to be 25%. So as you can imagine, that's a pretty big barrier for entry for most first-time home buyers that are looking to buy a primary residence and then house hack and rent out the other units. If you were going conventional, it was very difficult for you to do that. Well, now with this update, FannieMae is going to increase their maximum LTV, which means that they're going to reduce their minimum down payment, and they're going to make it 5% across the board, which is huge. So that means that you could get into a 4-unit property, bringing in as little as 5% down to get into that property and then benefit from the projected rental income from the other units. So this is going to dramatically impact home affordability, because when I'm qualifying you on your mortgage, I'm going to be able to include that projected rental income from those other units, and therefore dramatically impact your debt to income ratio that we have in the file. So this is huge news. This is going to go into effect on November the 18th. Okay. This is something that you can find on the FannieMae website. They did a newsletter announcement stating that this was going into effect on November the 18th. So since I'm by myself today, I am not going to do the interview segment. You guys know who I am. I'm a mortgage advisor, currently with Harmony Home Loans, and I've been in the game for, this is my 4th year in the industry. So next episode, we're going to have Nick McGarry, who is the CEO of Harmony Home Loans. So he'll be joining me on the show. We're going to do a little interview segment with him, get to know him a little bit better, so that you guys can understand who it is that is actually here with me in the company, who's running our team, and really who has the foresight to be thinking about what we're going to be doing in the future moving forward, and the leadership team that is actually here. So we got some amazing things that are in the works, including this podcast studio that I am currently sitting in recording this with you. So pretty big deal. We're definitely excited about what's coming down the pipe for us. Now, let's jump into this headline article. So this is from Housing Wire. Okay, this is a great website. You can go on here. There's a ton of information in regards to real estate articles, mortgage news articles. This is definitely a daily stop in for me when I'm taking a look and seeing, what is there something on here that I can use to create content? Is there news that needs to be shared on my social media platforms with real estate agents? So this article kind of grabbed my attention. Obviously, we know that interest rates have been climbing throughout the year. So here is the headline. Philly Fed President Harker says, quote, "We are at the point where we can hold rates," end quote. And it says, quote, "You may have noticed that I didn't tell you how long rates will need to stay high. I can tell you I do subscribe to the moniker higher for longer." So reading that headline, that tells me that the Fed is definitely going to be looking at possibly pausing on their rate hikes for an undetermined amount of time. They're going to want to see how these rate hikes that they've done over the last year are going to make their way through the economy. Are they going to start impacting the unemployment rate? Are they going to start impacting the employment rate as well? They want to see some more pain, I think, in the economy before they even consider doing any kind of rate reductions. So let's get into this. It says Philadelphia Federal Reserve President Patrick Harker advocated for stopping interest rate hikes, noting that disinflation is underway. Quote, "I believe that we are at the point where we can hold rates where they are," end quote. Harker said at the 2023 Mortgage Bankers Association Annual Convention and Expo in Philadelphia on Monday. Says, quote, "Disinflation is underway. Labor markets are coming into better balance and economic activity continues to be resilient. By doing nothing, we are doing something. And I think we are doing quite a lot," end quote. He told conference attendees that inflation is pegged to drop below 3% in 2024 and level at the 2% target thereafter. But in this article, it doesn't state when he's predicting in 2024 that we're going to start seeing those rates start to come down. A lot of the talk in the industry is sometime in Q4. The article goes on to say, "As a voting member this year on the rate-setting Federal Open Market Committee, or the FOMC, his words carry weight as policymakers contemplate their moves for the upcoming meeting on October 31st. The central bank has raised rates in the 5.25 to 5.5 range since it started its campaign to tame inflation in March of 2022. Policymakers foresee one more hike by the end of the year. The bulk of central bank officials expect to have interest rates finishing the year at around 5.6%. While the headline Personal Consumption Expenditure, or PCE, inflation remained elevated in August at 3.5% year over year, it is down 3 percentage points from this time last year. The PCE, price index excluding food and energy, the Fed's preferred measure, increased by 0.1% in August. The report that I told you came in a little hot, marking its smallest monthly increase since 2020. September's consumer price index rose 3.7% year over year, holding steady with August's annual gain and above economist expectations. Harker noted there can be challenges in assessing the trends in disinflation and emphasized that we will not overreact to the normal month-to-month variability of prices. As for future policy, Harker emphasized that rates will need to stay higher for a while. He says, quote, "You may have noticed that I didn't tell you how long rates will need to stay high. I can tell you I do subscribe to the moniker higher for longer." So this is something that the Fed has been kind of harping and speaking about in all of their meetings over the last couple of months is that they're not going to be afraid to keep rates at a high point for an extended period of time. So, you guys tell me, message us in, let us know, how long do you think rates are going to stay where they are? Obviously, we're waiting for inflation to come down. The interest rates are going to basically mirror whatever inflation does. So if inflation goes up, interest rates will go up. If inflation goes down, interest rates will go down. Then comes the conversation of, well, if interest rates do come down, then what's going to happen in the market, right? I live in Las Vegas, and that's where majority of my business is. Same thing for all of my real estate agents that I work with in Las Vegas, and they can attest that we have an inventory shortage, not just in Las Vegas, but on a national level. So if rates come down and we have no inventory, all of these buyers are going to come back into the market. They're going to be fighting over a limited inventory supply. So most likely we'll see bidding wars. Most likely we'll see property values go up. I saw an article a week and a half ago by Goldman Sachs that stated they're predicting on a national level that property values will grow between 5 and 9% over the next 5 years. So that is a pretty significant amount of equity growth in the properties. But you guys let me know, what do you think? So that's going to wrap it up for this episode of The Mortgage Mindset. Thank you for tuning in for the very, very first podcast episode. I cannot thank you enough for tuning in and giving me your time. Next week, we will have Nick McGarry here joining us in the studio, talk a little bit about mortgages and the mortgage industry and getting into business and what it's like running a team of young, hungry, ambitious originators. All right, guys, thank you so much. We will see you next week.